In 2009, central banks around the world cut interest rates dramatically to near 0%. It was supposed to be a temporary reduction to a short-term crisis. Markets and experts all predicted that interest rates would soon rise. But for 13 years, interest rates defied predictions, staying close to zero. But just as zero interest rates appeared to be the new normal, the 2022 inflation shock saw interest rates soar. Inflation proved worse than expected, and interest rates rose beyond many people's expectations. But then, towards the end of 2023, inflation has started to fall much quicker than people expected. And the really interesting question is, will the economic forces that kept interest rates close to zero for 13 years return? Or will the new normal be high inflation and high interest rates? Firstly, the long-term historical trend for real interest rates is for them to fall. They've been falling for centuries. And since the 1970s, interest rates have fallen considerably. In the short term, there are more reasons to be optimistic. Inflation will continue to fall. Oil and gas prices have fallen considerably in recent months. Food prices have fallen. And all the COVID-induced supply constraints, which did so much damage to inflation in 2022, appear to have eased. China, which is still the world's main manufacturing centre, is also experiencing deflation, with its property crisis risking causing further deflationary pressures in the Chinese economy. And this low inflation, this deflation, China will be exporting around the world in manufactured goods. For many months, the UK had higher inflation than Europe and America. It was something of an outlier, particularly affected by high gas prices and Brexit-induced food price shocks. But the recent inflation data has brought the UK back into line with Europe and America. Furthermore, the UK inflation was never really caused by strong economic growth and rising demand, which is the usual cause of inflation. In the UK, it was caused by cost-push inflationary pressures. And also, the past rise in interest rates from 0 to 5% will have a large negative effect in reducing demand, especially in the coming year, as over 1 million people remortgage to higher rates. The former governor of the Bank of England, Andy Haldane, warns that the UK is at high risk of a recession this year, and at the very least a prolonged stagnation which will reduce inflation and cause it to fall further. But going back in time, why did interest rates stay at zero for nearly 13 years? Well, the 2008 credit crunch caused an unexpected drop in demand, fall in house prices, deep recession. Banks were so short of liquidity they didn't want to lend at all. Even interest rates of zero were not enough to promote economic recovery, causing central banks to pursue a new policy, quantitative easing. In fact, some argue the reason interest rates remained so low for so long was that quantitative easing was artificially pushing down bond yields. But this doesn't explain why central banks kept base rates at zero. If quantitative easing had done its job in increasing economic growth, we would have seen some inflationary pressures return and the bank would have been able to increase base rates. It was only really in 2022 that quantitative easing started to be inflationary. Now, one theory for the recent period of ultra-low interest rates is that of secular stagnation. The argument goes that advanced economies in the West, with an ageing population, no longer see the same levels of investment and economic growth. Growth has slowed down across the world, be it Japan, Europe, America or the UK. There is a persistent lack of demand in the economy that is leading to low inflation, and in this environment of low growth, central banks have been keeping interest rates very low to try to stimulate investment. The pioneer of secular stagnation is Japan, with over 2 decades of near zero interest rates. And because of an ageing population, in Japan there's a greater demand for savings and little investment. And if this lack of demand for investment remains, there will be downward pressure on interest rates. European economies increasingly face the same demographic pressures of Japan. The birth rate in Europe has fallen dramatically and the population is set to fall. With this kind of demographic change, there will be weak investment and growing demand for savings. Now, if you agree with this theory of secular stagnation, then there's no reason why we could not return to that period of low inflation, low growth and ultra-low interest rates. Now, I agree that this may sound overly optimistic on inflation. If we look at underlying core inflation, it's still close to 6%, 3 times higher than the government's target of 2%. Nominal wage growth is still strong as workers try to recoup lost real wages. People no longer have quite the same expectations of low inflation and low interest rates. And the recent falls in commodity prices could easily be reversed. Oil prices have been driven lower by weak Chinese demand, but a new geopolitical shock could easily see a new bout of inflation. There's still a long way to go before inflation falls to the government target, let alone go below it. Also, the theory of secular stagnation, the idea that the West is stuck in a period of low growth and low investment, is challenged by many economists. They argue that the 2010s was a reaction to the unique circumstances of the 2008 credit crunch. 2008 was an unusual recession in that it was accompanied by a property crash and widespread bank losses. It is something called a balance sheet recession, which tends to be much harder to recover from. Now, despite some banks being exposed by higher interest rates, there's not the same kind of financial Armageddon at the moment. Also, in the coming years, governments face pressure to borrow and invest for a transition to a net zero green economy. There's a demand to invest in building new houses in the West, or spending to deal with climate change, or artificial intelligence may stimulate private sector investment. It's too simplistic to say that an aging population automatically means lower investment and lower growth. And finally, as central banks reverse quantitative easing, this will be an upward pressure on bond yields and interest rates. Another factor that's important is productivity growth. If the economy experiences new technology and costs are falling, then it enables the economy to grow more without inflation. However, if productivity growth falls to zero, like in the UK, then even low economic growth can cause inflationary pressures. This is one reason why UK had inflation despite very weak economic growth. It explains why the Bank of England increased interest rates in the teeth of a recession. Now, this video is not a prediction that interest rates are going to return to zero in the short or even medium term. But if we had zero interest rates for 13 years, it's definitely a realistic possibility that we could return to that climate of low inflation and low interest rates. Inflation rose higher than many economists forecasted, but in the second half of 2023, it also fell faster than many predicted. One thing I hope we can learn from this video is that predicting interest rates is really quite a difficult job. In 2006-2007, the idea of zero interest rates was really hard to imagine. In 2009, no one really imagined 13 years of near zero interest rates. And at the start of 2022, how many people were predicting 14 consecutive increases in UK interest rates? It's also worth adding that I hope interest rates don't fall to zero. It might be good for my mortgage, but in the long term, ultra-low interest rates are not helpful for the economy. It tends to distort investment decisions, encouraging people to invest in property, land and houses, rather than, say, manufacturing or more productive uses of capital. It also makes central banks rely on quantitative easing for monetary policy, and this has numerous side issues and not particularly desirable. You could argue that the period of ultra-low interest rates in the 2010s caused asset price inflation, if not actual inflation. Back in May 2023, I had a choice between a fixed mortgage and a variable mortgage. And in the video, I explained why I chose a variable mortgage. Essentially, to me, it made no sense. The UK had such high inflation, given such weak economic growth. With the economy barely growing, I was hopeful that inflation would fall quite quickly and that this would enable interest rates to come down. Now, ironically, a few days after signing my mortgage contract, inflation came in higher than expected and mortgage rates actually rose. It looked like a bad decision, at least for a few weeks. But 9 months on, it looks more optimistic that interest rates have peaked and could actually start to fall quicker than expected last year. What about all the other forecasts for 2024? How is the UK economy likely to fare? This video looks at how the economy, inflation, interest rates and house prices all might perform in the coming year.